We all dream of making it big in the stock market. The idea of turning a small investment into a fortune overnight is incredibly appealing. Stories of people who bought the right stock at the right time and became wealthy in a matter of days or weeks are everywhere. These tales fuel our imagination and make us believe that we too can strike it rich if we just pick the right stock. The excitement of watching numbers climb, the thrill of seeing your money grow, it's hard to resist. Seeing a stock price skyrocket overnight is tempting. It feels like a once-in-a-lifetime opportunity, and many people rush in, hoping to catch the wave before it crashes. The media often highlights these dramatic success stories, making it seem like anyone can get rich quickly if they just act fast enough. But behind every soaring stock, there may be more than meets the eye. But what if this excitement is artificial? What if the stock is fundamentally weak? Many investors get caught up in the hype, only to realize too late that the company behind the stock isn't as strong as it seemed. The initial excitement can quickly turn into confusion and anxiety as prices start to fall just as rapidly as they rose. This is where manipulation comes in. Sometimes, the dramatic rise in a stock's price isn't due to genuine growth or positive news, but rather the result of behind-the-scenes actions by powerful individuals or groups. These players know how to create excitement and draw in unsuspecting investors. Big players, often called operators, can artificially inflate stock prices for their benefit. They have the resources and influence to move markets, and they use these advantages to create a false sense of opportunity. By driving up prices, they attract everyday investors, only to sell their own shares at the peak, leaving others to deal with the losses. They use clever tactics to create an illusion of demand and lure unsuspecting investors. These tactics can include spreading rumors, placing large buy orders, or using social media to hype up a stock. The goal is to make it look like everyone is buying in, so that more people join the rush without doing proper research. Let's understand how they do it and, more importantly, how to protect ourselves. By learning to recognize the signs of manipulation and staying informed, we can avoid falling into these traps. Education and awareness are key to making smart investment decisions and safeguarding our hard-earned money. Remember, knowledge is your best defense against such manipulation. The more you know about how the market works and the tactics used by manipulators, the better equipped you'll be to make wise choices and protect your investments for the long term. In the world of finance, there are powerful players who operate behind the scenes, often large investors or influential institutions. These entities are sometimes referred to as the puppet masters of the market, quietly pulling strings that most everyday investors never even notice. With vast resources at their disposal, they possess the financial muscle to sway market movements in their favor. Their trades can send ripples or even waves through the market, shifting prices with a single decision. This power allows them to shape trends and influence outcomes, often without drawing attention to themselves. But these operators rarely target the big, well-known companies. Instead, they set their sights on smaller, lesser-known firms, those with low trading volumes and limited public attention. These companies are often overlooked by the broader market, making them especially vulnerable. The reason is simple. It's far easier to manipulate a stock when there are fewer buyers and sellers involved. In these thinly traded markets, even modest trades can have an outsized impact on the price, allowing the puppet masters to move the stock almost at will. These vulnerable stocks become sitting ducks, easy targets for manipulation. The operators can quietly accumulate shares, push prices up or down, and profit from the resulting volatility, all while staying under the radar. Because these stocks attract little media coverage and are ignored by most investors, they're perfect for the puppet masters' schemes. Their actions often go unnoticed until it's too late, leaving unsuspecting investors to deal with the aftermath. The manipulation begins with a stealthy phase called accumulation. The operators start buying shares of the target company. They do it slowly and discreetly, using multiple accounts to avoid raising suspicion. This slow and steady buying creates a false impression of genuine interest in the stock. It's like setting the stage for a grand performance, but the play is rigged from the start. This is where the real manipulation begins. Circular trading. It's a deceptive practice that takes place behind the scenes, often invisible to the average investor. Here, a group of operators or traders work together, coordinating their actions to create a false sense of activity in a particular stock. Their goal? To make it appear as though there's genuine interest and excitement, when in reality, it's all just an elaborate illusion. The operators start trading the stock amongst themselves, using their multiple accounts. They might even use accounts registered under friends, family, or shell companies to further disguise their involvement. Each trade is carefully planned, with buy and sell orders placed in rapid succession to simulate real market demand. They buy and sell at increasingly higher prices, even though there's no real demand from genuine investors. The price keeps ticking upward, not because the company is performing well, but because the same group is passing the stock back and forth, inflating its value with every transaction. This creates an illusion of increased trading volume and rising prices. To outsiders, it looks like the stock is on fire, attracting attention from unsuspecting investors and even the media. The charts show a surge in activity and the buzz starts to build. It's like a game of hot potato, but instead of a potato, it's a stock with an artificially inflated value. Eventually, someone is left holding the stock when the music stops, often losing money when the price inevitably crashes back to reality. Circular trading is all about smoke and mirrors, creating hype, hiding the truth, and leaving real investors at risk.